Yeah, hello again. Here is again the taxation lecture, and we have a small chapter today, loss carry forward in corporation tax. And well, let's just begin. You probably remember the rules from the Income Tax Act that meant if you have a total income which is a loss, you can transfer that loss to other years. Um, in this way. The first alternative is you can carry the loss backwards to a previous year. So that leads to the consequence that your tax assessment for that previous year gets corrected. Your tax burden for that previous year gets lower than before. And after that correction, it will turn out that you have now, under the new data, have paid too much money for the previous year, so you will get a refund. That is the thing which makes such a loss carry backwards attractive, because it easily and quickly gives you new liquidity, a refund from the fiscal office. Such a loss carry backwards can naturally only be done in a limited way, because naturally when the state gets money, the state tends to spend it. So you can't allow people loss carry backward of 500 million or so, because that is money which you already have spent. So a loss carry backward can only be allowed in a rather limited way, which does not affect the total tax revenue of the state too much. So Germany sets a limit of usually 1 million. In the year of 2021, this 1 million has been for 1 year only been increased due to the corona crisis. But as next year the limit will go down to 1 million again, it makes no sense to memorize this temporarily increased limit. For you and me during education, it's 1 million which you can carry backwards. The loss carry forward can be chosen for every losses which you could not carry backward. And what I should still mention is there might be situations where a loss carry backward is not so attractive for you. So for the loss carry backward, you have an option to limit it or even to renounce on it. If you apply so, you can avoid it. But everything which could not be carried backward is automatically carried forward to future years, and then it will be set off against the income of these future years. That loss carry forward, is under German law done in two different steps. First, up to 1 million losses can be deducted completely from the total taxable income of that future year. And then from the remaining amount, you cannot bring everything down to zero, but only 60% of the remaining amount of your taxable income in that future year can be set off by the loss carry forward. And if there are some losses left over, then you can again carry that rest forward to the next years. The idea is if somebody has a really good year, let's say 10 million plus, it would be undefensible, difficult to justify that if that person in that year pays no taxes at all. So it was regarded as a useful compromise by the legislator to say, okay, people with a rather small income up to 1 million can offset their losses completely. But if you earned more in a year, you should not end up that year without paying any taxes at all. And so the compromise was 60% of your income can be set off by losses, but on 40% of the remaining amount you will have to pay income tax. Now, That works as follows. Imagine an enterprise made a profit of 500,000 in year one, a loss of 3 million in year two, and again a profit of 2.5 million in year three, or let's say instead of an enterprise, a person. Well, the final results for the taxable income of each year will be as follows. Year one originally had 500,000. Now, if you don't restrict the loss carry backwards, everything here is used up by the loss carry backwards. So 500,000 from the losses of year two are carried backwards. The new income of year one is now a zero, so all the taxes which you originally paid for year one will be refunded. Now, from your 3 million of losses, you have already used up 500,000, so 2.5 are left over and become a loss carry forward for year three. In year three, you have an income of 2.5 million. That's my assumption in the data just above. An amount of 1 million can be offset due to the loss carry forward in the first step. So after that first step, your income has dropped down to 1.5 million, and the loss carry forward is also reduced by that 1 million losses which you have used up. Now the remaining losses are 1.5 million. In step two, you can now have a look to the remaining income, 1.5 million, can calculate 60% of that amount, that would be 900,000 in our case, and up to that limit you can still offset the loss carry forward in that year. So you have 1.5 million, so up to the limit of 900,000 can be deducted. So the taxable income of year three goes down to 600,000. And again, you have a look to the loss carry forward. You had 1.5 million. You deducted 900,000, so 600,000 loss carry forward are still remaining and will be carried forward to year four, and so on. Example 2. Enterprise makes now a profit of 1.1 million in year one, a loss of 5 million in year two, again a profit of 3 million in year three, and a profit of 2.5 million in year four. What happens? Well, the final results will be as follows. First, let's try loss carry backwards. 1.1 million, well, you can carry backwards 1 million at most. So we do that, and we have a remaining income of 100,000 now only in year one. So you get a tax refund because from the new perspective, you overpaid your taxes for year one in the first assessment. Okay. The loss carry forward is now reduced by the 1 million from 5 million to 4 million. Year two is naturally again a zero income, no positive income. Year three, we have started with an income of 3 million from this year. The first step is you can deduct 1 million loss carry forward immediately. The remaining income is 2 million, and the loss carry forward drops down from 4 million minus that 1 million to 3 million. Step number 2. The remaining taxable income can be used with 60% to be set off against the loss carry forward. 60% of 2 million remaining income is 1.2 million this year. So we have a loss carry forward which is higher, so we can use up the 1.2 million completely against the loss carry forward. And by the way, under German rules, a loss carry forward is not an optional thing, it's compulsory. So it cannot only be done, it will be done. So the taxable income of year three goes down to 800,000. 2 million were left over after step one. 800,000, 1.2 million are deducted. 800,000 is left over. The loss carry forward After step 1, we had 3 million left. Now 1.2 million are used up. So the remaining LCF is now 1.8 million. Year 4. In my case, we assume that in year 4 you have an income of 2.5 million. 1 million can be immediately deducted. So the income goes down from 2.5 million to 1.5 million, and the loss carry forward drops down from 1.8 to 0.8 million. So 800,000 losses are still left. In the second step, we calculate again the limit for step 2. Up to 60% of the remaining income can be used for the loss carry forward. 60% of 1.5 million, which are left over still, is 900,000. Now let's have a look to the loss carry forward. We only have unused losses of 800,000, so the 800,000 are fully within the limit. They can be fully deducted. The income goes down from 1.5 million by these 800,000 to 700,000 taxable income, and the loss carry forward is completely used up and is now a 0. So that's the way how it works in income tax, usually for a person. Now, surprise, corporation tax, exactly the same rules and the same principles. So where I wrote enterprise, better person on the last slides, you could just exchange that for company and exactly the same thing happens. In the last chapter, I spoke about the deduction of donations, and for the donations, you need the amount of the taxable income. There was also a limit of 20% deductibility of the income, and so naturally the sequence of the calculation becomes interesting. And here in KSTG, if you look it up in the guidelines of the fiscal administration in Germany, you see that the required calculation sequence is a bit different from income tax cases. In case of KSDG cases, you begin naturally with the commercial profit. You change it by corrections into the tax per profit, as we have done this in the previous chapters. Now you deduct first the donations. 20% of the tax profit is the limit. What comes out is now the total of the income, and surprise, this is now the basis for the loss carry forward. 1 million are deducted first, and then from the remaining amount up to, and afterwards 60% of the rest are still deducted. The footnote gives you a hint. In income tax cases, the sequence of these two steps is exactly the other way around. Happens. Well, so there is another aspect which needs to be discussed. Such a loss carry forward thing gives you an opportunity, at least in theory, to save taxes, because you must clearly see such a thing. If there is a juridical person which has a loss carry forward, this brings along a financial advantage, because you have now a person, a juridical person, which can in the future, during the next years or decades, in principle without a time limit, earn up to 100 million, if the loss carry forward is 100 million, without having to pay taxes on them. Now, this is something which is attractive. So the logical consequence would probably be, imagine you want to set up a new enterprise. You want to set up a company. Now you can set up a new one, but that would be bad, because a new one starts with an empty tax file with a zero income, and so if you earn 10,000 euro, you will have to pay taxes for them. On the other hand, if instead of establishing a new juridical person, you look for an existing company which has from former activities a huge loss carry forward. No debts anymore, but huge former losses have been suffered, paid off, and so on. Now you could take over the shares from the previous owners, and now you own that already existing company, and you could use it to run your business. And now the thing would be, this company has a loss carry forward of, let's say, 100 million. So with that company, you could earn up to 100 million without ever having to pay taxes. And that would be really attractive. By that maneuver, the founder of the new enterprise could benefit from the losses which somebody completely different had suffered during the last years. That's not really what the tax law wants to achieve. It's not a desirable outcome, so it should be avoided. Now, because otherwise nobody would ever be willing to set up a new company, they would be desperately on the look for companies on the verge of bankruptcy in order to buy them, to buy the remaining shell, the name and the company itself, even if it has nothing else left over than losses and a name. That would be sufficient. So new companies would have a disadvantage, and we all would be looking for bankrupt ones which are still alive, but completely, bankrupt in a certain way, sitting on a huge mountain of old losses. How can we avoid that? The answer is simple. The German legislator chose a special rule that is 8c KStG, and the basic principle is simple. If the shares in a company are sold to new owners, then the loss carry forward is cancelled. Naturally, that can't be done if you only sell a single share. But if the vast part of the shares is sold to a new owner, so if somebody new takes over the control over the company, more than 50% of all capital of a company are sold to a new acquirer, or to an acquirer and persons who are under the control of that acquirer, or to a group of several persons who act together with the same interest. Then the loss carry forward is cancelled. Now, naturally, you could easily avoid selling 50% by selling 10% in June, 10% in July, 20% in August, and then selling 30% in October. So naturally, that would be too easy. Just to look to a single transaction of 50%. So the rule says if within a given period of 5 years, more than 50% of all the shares in a company are sold to a new acquirer, then that triggers the cancellation of the loss carry forward. The idea is, in that case, there is a certain suspicion justified that somebody wants to buy the loss carry forward. On the other hand, there might be cases where such a measure is not justified because the company is not bought in order to abuse the loss carry forward of somebody else. It might also be that somebody buys the firm in order to save it and to keep it running. So there are certain exceptions from that principle. The first thing is, as far as there are unrealized gains, hidden reserves in the asset of the company, the losses remain deductible. That's very easy because these losses these gains could be realized by not selling the company but selling the assets individually. And so the company could realize these gains immediately, and so it could still realize gains which it could set off against the loss carry forward. And well, the idea here is if the company still has potential gains which could use up the losses in the future, that cannot be an abuse. On the other hand, the second motive is, or the second case is more interesting. If the acquisition is made with the aim to save the company from insolvency and maintain its functioning, the losses remain deductible. The problem is, or the reason is, then it's not an abuse, then it's just the idea we want to save the firm. We need new shareholders, we need additional capital, we need somebody who pushes in money into the firm. And if that person wants to contribute money to the firm, very often that new shareholder wants to take over control over the company because, well, if the old managers ruined the firm, probably the new shareholder wants to have a say in the fate of the company and wants to have the decisive say because, well, it's your money which you risk, so you want to have the decisive influence on the firm's policy. So that would be not an abuse, but here the old firm continues to exist. Now, however, it is a bit difficult to prove that it's not an abusive takeover in order to start a new firm, but just continuing the existence of the old firm and saving the old firm. So 8C for that case sets up set of conditions which you have to fulfill either as a whole or at least some of them. For example, it would also be suspicious if you take over a firm and that firm has already given up its business nearly completely, or if you take over a firm which runs a bakery and then later change its field of activity to something completely new, so that after some 2 years or so, your bakery has been turned into a car factory. That would be a bit suspicious. So you have to check things properly there. And there is also some other possibility to avoid the cancellation of a loss carry forward in case of the change of a major participation in the course of 5 years. So the 8C situation. If you apply for a review of your firm's policy and fulfill some very, very complicated conditions which are laid down in paragraph 8D KSDG. So what that means overall for practical cases is buying a shell company which has no active business anymore but only a name and a loss carry forward is probably not working, because the loss carry forward will be cancelled if you buy the majority of the shares. Now, becoming a shareholder of a company which has problems can bring along problems too for the loss carry forward. If a new shareholder or a new group of shareholders comes in with more than 50% of the voting rights, in that case you must thoroughly examine if the conditions for the continuation of the loss carry forward are met successfully. And that's everything which you need to know about loss carry forwards. So let's end this small little chapter and hope to see you back soon for the next small little chapter of corporation tax basics. Thanks for watching. Goodbye.